So today I have something really special for you. I'm thrilled to introduce you to the latest member of the Ready Set Crypto team, Checkmate, who will be joining Doc and I and is a master of fundamental analysis. More specifically today, he's going to be talking about Bitcoin and on-chain analysis, but look forward to more content from him and the rest of the Ready Set Crypto team as we continue to bring you the very best in fundamental analysis, technical analysis, and sensing the pulse of where the crypto industry is going. So without further ado, I'll turn it over to Checkmate. Welcome to Ready Set Crypto. This is your brain on blockchain.
Hello everyone, and welcome to something a little bit different this week. I'm Checkmate, and I'm a new addition to the Ready Set Crypto team. And what I'm excited to bring you today is an overview of some of Bitcoin's on-chain analysis indicators, and really trying to put a little bit of context to the recent rally that we've seen off the bottom of 3150. There's a growing toolkit of studies, concepts, and ideas that are being established by some of the brightest minds in the industry, and the field of on-chain analysis is really going to be a tool for the smart money moving forward. So today I want to introduce some really powerful on-chain techniques and try and put some context to the Bitcoin rally and see where we are in the market. Given the characteristics of this rally, I really believe that at least from a technical analysis perspective, it's unlikely that this is just setting up another bearish lower high and is indeed signaling a new wave of positive sentiment and developments in the space. At the same time, however, there's a good reason to expect a modest pullback or at least a consolidation, considering a lot of the on-chain behavior and particularly the transaction flows that are occurring on the Bitcoin ledger. So I want to start initially with why the bear market most likely ended in earnest in the 2nd of April, and why on-chain data is not quite supporting the same price appreciation that we've seen of late. So it closed out the year in 2018 with a significant drop, which we now know to be a capitulation phase, and it was supported by a massive spike in exchange volume and armies of pundits who were calling for $1,000 Bitcoin. Now, what the smart money noticed, particularly those who are savvy with on-chain analysis, is that this actually put the spot price below the realized price, and historically this is shown to be the period of maximum opportunity for accumulation. So the April 2nd short squeeze pushed price firmly above this 4,200 level, which coincided with the realized price, and really did confirm the uptrend into a bullish market. So this significant breach above the realized price means that on average, as a cost basis, the market is now in profit. It's certainly supported by the exchange volume that we've seen, however so far has not quite been supported as heavily by the on-chain volume. So we make the distinction here between the spot price, which is representative of the speculative value and is tainted by emotion and exchange-driven off-chain trading volume, and the realized price, which is more of a metric of stored wealth and the on-chain hodling and utilization of the Bitcoin base layer as a transaction protocol. Up until the December 2017 peak, exchange-based volume has effectively trailed the on-chain volume, being of a lesser magnitude to the amount of value that's been transferred in USD over the Bitcoin network. Now, what's interesting here is this was representative of the industry starting to find its legs, exchanges starting to grow in the amount of coins that they actually held, and additionally more volume being transferred into altcoins during the mania phase. After the December peak, exchange volume and on-chain volume really started to move into sync, and we saw a good match between the amount of exchange volume, on-chain volume, and actual price of the Bitcoin network. So this really did represent a trader's market. We saw the realized cap maintain a fairly stable level through this zone around 5,000, and this really acted as a base level of support for a good portion of the 2018 bear. If we now look at the context of today's rally, what we've started to see is a significant divergence between the exchange-based volume and the on-chain-based volume, which really started during the capitulation phase in December 2018. What this really suggests to me is that a good portion of this particular rally is occurring on exchanges rather than from true investor hodler behavior. What we would expect during true accumulation would be a lot more on-chain transactions as coins are then purchased and then transferred off into cold wallets for the long hold. What we've seen here is a significant divergence in these two metrics, and we're seeing a lot more of this action going on exchanges. On-chain analysis Jedi Master Willy recently tweeted about this, where he talks about this divergence between the exchange-based volume and the on-chain-based volume as being somewhat less organic to what we've seen in previous disbelief and bullish markets, and not necessarily representative of true intrinsic demand from the investor side, and rather a lot more focus on the short squeeze, on quant traders, and on the basis of more hedge funds entering the space and having larger check sizes with which to actually move the price. He goes on to talk about the NVT price, which is effectively an estimate of a fair network value considering the degree of utilization or the amount of transaction flow that's actually occurring through the Bitcoin protocol. What is also noted here is that taking a fair value for the NVT price and mapping out where the price is today and doing the comparison, we note that there is a significant divergence between true utility and actual price appreciation. To put the NVT that Willy refers to into context, it's effectively the ratio between the market cap and the daily on-chain transaction flow in USD, with some moving averages applied for smoothing. So given that price and market cap are relatively volatile for this asset class, I personally like to use the realized price in the numerator, forming the RVT ratio. This is essentially the same metric, just maps the realized price, which is a smoother curve, to the transaction flow. What the RVT gives you is a slightly slower but higher conviction signal, whereas the NVT is a lot more responsive, but also a lot more noisy in response to this volatility. For both the NVT and the RVT ratios, a high value is fairly commonplace in a bear market, where price is much higher than the actual utility value and the transaction flow is relatively low and largely dominated by exchange-based volume. When a low value kicks in, it generally means that transaction volumes are kicking up or price has depreciated to a point where it's in a period of accumulation. And what we can use these ratios to do is to establish these macro shifts between bullish and bearish market sentiment. So what the NVT provides is a relatively fast signal, and it's historically shown that a strong break above the value of 10 can indicate that a market is starting to top out. What the RVT provides is a slower but much higher conviction signal, and when it breaks above 10, it usually confirms that the bear market is in effect, and conversely, when it breaks back below 10, it has historically remained there for the duration of a bull market, suggesting that there is sufficient demand for on-chain transaction space to support continued bullish sentiment. Now, bearing in mind that this value of 10 is an empirical observation based on only a handful of Bitcoin cycles, it's likely to change over time, but for now acts as a historical reference point for understanding this metric. This makes sense, as a ratio of 10 effectively means that the on-chain transaction volume is around 10% of the Bitcoin market cap or realized cap, depending on which metric you're looking at, and is generally a sign of positive momentum in the market. In the 2019 rally we've seen so far, the RVT is indeed approaching that key level, but is lagging behind price compared to what we saw in 2015, and similarly the NVT is diverging, potentially indicating more speculative value in the market rather than true utilization. As a final on-chain indicator in this puzzle, the unrealized profits metric has accelerated at a rate we've not seen since the earliest bull market in 2012. The unrealized profits metric is essentially the percentage difference between the market value right now and the realized value. And this metric is indicative of, on a cost basis across the whole market, what is the percentage of profits that are still on the table. And what we're seeing at the moment is that price is currently sitting at around a 40% unrealized profit margin. Now, what's interesting to note here is that back in 2015, the unrealized profits metric at least paused or consolidated for a number of weeks at around the 20% range and then again at the 40% range, which indicates that coming out of the bear market, some degree of profits were taken on that first rally. What's interesting for this rally is that we've basically seen price slice straight through that 20 to 40% range with very little resistance. When we couple this with the fact that the realized price hasn't quite accelerated to the same extent as what we would expect if we were seeing true hodler volume and we were seeing coins being purchased and then withdrawn from exchanges, it does stand to reason many of the Bitcoins that have been traded during this rally are actually still located on exchanges, and thus may quickly become a source of overhead supply if a pullback does continue to play out in earnest. This unrealized profits metric was also picked up by Tur Demisa from Adamant Capital. His article talks about a number of different mechanisms as to capital flight from China and other metrics that may explain why we're seeing this exchange versus on-chain volume divergence. and there's an obvious part to play with exchanges having an increasing custodian role and systems like Lightning and Liquid starting to go live. But overall, what we're seeing is that this particular rally doesn't quite have the same characteristics on-chain as what we've seen in previous disbelief rallies. It certainly suggests that the price action of late has been more driven by speculation rather than true organic utilization. So overall, the break above that 4200 level, to me, certainly has all the hallmarks of the end of the bear market and certainly a move into a new bullish environment. And there's no question that there's more fundamental developments in the Bitcoin space than has ever been in history. With that in mind, in the short term, I would still expect some kind of at least a weekly consolidation or potentially even a strong pullback to really get a lot of the leveraged positions on the wrong side of the boat, and I would not be surprised to see price retrace down to somewhere around the $5,000 to $6,000 range, which is the approximate center of gravity for a lot of the on-chain fair market value models, bearing in mind that this new bullish sentiment will provide strong support on the way down. So to finish up, I want to thank you all for watching. And if you're keen to learn more about on-chain analysis or looking to how to employ it in your trading arsenal, please let me know in the comments below. If you really want to delve further into what on-chain analysis is all about and what some of the latest and greatest techniques are that are being developed, stay tuned for our masterclass on the subject, which will be live on our website in a couple of weeks. So I hope that you found this on-chain analysis video interesting, and I'll look forward to exploring more of these concepts with you into the future. Until then, thanks for watching. Cheers.